stocks that have a lot to lose, I want to talk about the IPO of Robinhood. This was one of the more highly anticipated IPOs. After all, this really encapsulates the entire, meme stock investing theme, where the public is just buying everything, no regard to fundamentals, pure gambling. In fact, a lot of people have taken their stimulus money and deposited directly to their Robinhood accounts. And of course, Robinhood was at ground zero for the GameStop short squeeze. In fact, a lot of people were upset at Robinhood when they halted the ability of people to buy GameStop or to leverage up to buy GameStop. So there was a lot of people focusing on this IPO. They supposedly have democratized investing. Of course, Robinhood is not about investing at all. It's about speculating. It's about gambling. If anything, that's all they've democratized. And they're not helping the little people, right, rob the rich, right? That's the whole name of Robinhood, is where, you're taking from the rich and you're giving from the poor. Well, what Robinhood actually does is it helps the rich take from the poor, because the people who are losing are the customers or the people who have accounts at Robinhood, because they're not actually the customers. Those people are the product. The customers are a few hedge funds that are buying all the order flow so they can trade against all the Robinhoods, right? So all the merry men who have got accounts at Robinhood are losing a bunch of money, and the people who are making the money are the rich sheriffs who own these hedge funds. The reason they're buying all these orders is because they're making a lot of money off them, because the people that have Robinhood accounts, by and large, don't know what they're doing. Now, sure, some of them may have made some money, but they're going to give it all back. It's not like everybody who goes into a casino loses money right away. Of course not. I mean, there are people who win at casinos. They just don't win consistently. They don't win forever. They give it back, right? That's why the casinos are so opulent. That's why you look at how grand these casinos are and how much money they spent building them. It's not because they're losing to their customers. The gamblers are the ones that are losing. The house is winning. And the house, when it comes to Robinhood, are the companies that are the real customers that are paying for all the order flow so that Robinhood's account holders can trade for free. But while they're trading for free, they are losing their money. And to the extent that they haven't lost it all yet, it's just a matter of time. Because if you look at the stocks that Robinhood's account holders are concentrated in, they own the most overvalued stocks in the market. They own the stocks that are likely to fall the most during the bear market, especially if the bear market is a result of inflation. And also, of course, not only is Robinhood generating revenue from stock trading, they generate a lot of revenue from cryptocurrency trading. In particular, more recently, Dogecoin is where I think some of the greatest revenue is coming from. The reality is, if you look at the market environment that Robinhood has recently been operating in, things could not get better, right? You have all these individual investors who haven't lost all their money yet, who are gambling like crazy. They're trading constantly. They're also chasing all these meme stocks and jumping into these cryptocurrencies. So you have all of this volume. So when it comes to Robinhood's business model, things probably couldn't get any better than they are right now, which is why they're going public, right? They're not going public because they have a small business that they want to expand. They're going public because they have a big business that's probably not going to get any bigger, and all the insiders want to cash out, which means all the people who are buying are just patsies enabling the insiders to get out. And ironically, a large percentage of the buyers are, in fact, the little guys who have accounts at Robinhood, because they were allocated, I think, something like 25% of the IPO. Now, focusing on the IPO itself, the stock was priced at $38 a share, which in and of itself means nothing until you think about the market cap of the company, which at that price was $32 billion. Think about the absurdity of Robinhood, that app, being worth $32 billion, because they're not even making money. Despite the best possible circumstances for the company where they probably have had more revenue than they're ever going to get, yet they still didn't make any money. So if they couldn't make any money during these ideal circumstances, how are they going to make money in the future when the circumstances will be less than ideal? They're probably going to end up having more competition. They may lose some of their real customers because there could be some more regulation on the hedge funds that are buying all the order flow. Their customers, of course, could get wiped out, right? If you're operating a casino and all the people who go to your casino are broke, well, they're not coming back to the casino because they've lost all their money. So their customers are going to get wiped out. There's going to be more regulation. There's going to be more competition. I don't see any way this company is going to maintain a market cap anywhere close to $32 billion other than through massive inflation, which of course we're probably going to get. But then the real value of that $32 billion is going to collapse. But even with massive inflation, I still think they're going to struggle to keep that market cap. In fact, if you look at the way the IPO played out, it immediately crashed below its IPO price. In fact, on Friday, the stock traded as low as $33.25. The IPO was 38. That's about a 12.5% decline in the price of the stock the day following the IPO. And that ranks it as one of the worst IPOs ever. In fact, on its opening day, it may in fact have been the worst IPO ever for a major IPO. So complete disaster, breaking that syndicate bid. I mean, normally the investment banks do everything they can to try to at least hold the IPO price, and they're in there buying, but obviously they couldn't do it. They were overwhelmed by the number of people trying to immediately get out of that stock. And I'm wondering how many of the people that have Robinhood accounts actually sold, because to the extent that they want to get IPOs in the future, they are penalized if they don't hold on, I think, for at least 30 days. And then if they don't hold on, I think maybe they can't get another IPO for maybe another 90 days or something like that. So a lot of the Robinhood people, they may be hodling their Robinhood shares, and it's probably some of the bigger players that have rushed for the exits because they didn't get an immediate pop. See, normally the guys in the IPOs, they want that pop, right? They want to buy it and they want it immediately to close 20%, 30%, 50%, 100% above what they paid. But if they don't get that, if they don't get a bounce, well, they just want to cut and run, because if the stock's not going to go up, well, it's got a long way to go down, because who knows what the real value of this company is. People were only buying it because they expected a pop. They didn't get one. Now they want out. What's it actually worth based on its capacity to earn money or maybe pay a dividend? I think it's worth a fraction of its current price, and we might see that in the days ahead as this stock ultimately tries to find some type of bottom at some reasonable price.
Buying Robinhood's IPO? Robinhood is going public under the ticker HOOD and making their IPO available to all their users. And Robinhood is growing really fast. They've basically quadrupled users and revenues over the last year with the popularity of stock trading. And they're now really profitable, making almost $115 million in the first quarter of this year. If we can buy the stock at a $30 billion valuation, then that would value the company at 14 times revenues and 16 times gross profit, which might actually be a good deal, except that there's huge risks here. First, we don't know if trading activity will fall off after the pandemic. Plus, over half of their revenues come from options and crypto trading. So they rely more on gambling activity rather than long-term investing. And finally, they're underwater with lawsuits. They just had a $70 million settlement with FINRA, and the SEC is investigating them for selling your orders to market makers, which is how they make most of their money. So if the SEC bans this practice, Robinhood could lose up to 80% of their revenues, which is why I'd think twice before.
So if you're thinking about investing in the Robinhood IPO, which a lot of people are, like a lot, here's the one question you should ask yourself. Are you looking to invest for a quick buck or for the long term? If you're looking to just make a quick buck, you should know that IPOs tend to be the most volatile times a stock has. For example, here's Lyft, a commonly known brand, at the IPO day, and it did not do that well over the coming months. Uber, on the other hand, also did the same thing, but pulled back. IPOs tend to have a lot of risks, so I just want everyone to be careful. If you do your research and you look at the actual financial statements when the IPO is announced, and after looking at those statements, wait a couple months and feel as though it is a good investment for you, then make your decision based on that data and not just emotions.
There was serious hype around the Robinhood IPO, and let me tell you, it did not go so well. This chart behind me basically just shows you that it is the worst IPO of its size. That tells you something. I'm going to stress this point right now. Do not get sucked into the hype. Choose companies that are strong, that are good, that their financials are there, that make a consistent revenue, and that look good long term if you want to hold it long term. If it's a swing trade, different story.